Let me also welcome on board then Shyam Srinivasan, MD and CEO at Federal Bank, joining in the show. Mr. Srinivasan, great to have you on the show, and congratulations. A big overhang got lifted when we got the news that your tenure has been extended.
Thank you so much, Aisha. Yeah, it's a good place to be, right? You know, we have a job for 3 more years. Can you hear me?
Yeah. Okay, let's talk about what's at your hand right now. Yes, I can hear you very well. Let's talk about the numbers then, how the quarter went by, and help us understand whether or not you could manage to wade through the storm of the second wave, because many retail-focused banks have taken a hit.
You may have seen, Aisha, thankfully, the sort of rate of deterioration was lower than what all of us thought may be. So to that extent, the portfolio's inherent strength is holding out quite well. We also made meaningful provisions, even for businesses like gold, which are 100% secured. We made 65% provision. So every slippage, for every 100 rupees of slippage, we made 65 rupees of provision, way above the normal IRAC requirement. So I think we exit Q1 having recognized the stress and well provisioned. So I do believe if we are living in a healing economy, I do believe in the quarters ahead, it should start looking much better. But at this point in time, the portfolio is holding out relatively well. For long, we've curated a book which is very secured and relatively higher rating customers. So that's playing through. Corporate book has seen mercifully no major stress. Gold, barring the temporary blip, is looking okay. Retail, which is largely home loans and loan against property, between some slippages and restructuring, I think we're dealing with it quite well. The pockets of business, which is business banking, commercial banking, where there is an inherent stress in the economy, needs some nurturing. Wherever possible, we are helping that out. If not, they've been made, they've become an NPA and we have provided and have to move on. So broadly, that's the picture, Aisha.
Hi Shyam, good morning. Thank you for joining us. My question, Shyam, is that in this entire pandemic, what we've seen is that we've seen bigger banks have got large part of Kasa. And that's the nature how a pandemic does, that big players, they become bigger. It's evident in the industry media which I represent. It's evident in other sectors also, which we both track. What has happened to the Kasa and the other market cap ratios of Federal Bank?
You may have noticed, Nikunj, in this quarter, our Kasa was the highest ever. And in some sense, I'm happy to hear that the bigger banks gain share. We've gained share in Kasa, particularly savings. CA tends to be a little volatile because of a range of things. Inherently strong is SA. In fact, our blended cost of funds was its lowest ever at 4.45. I think in our league of banks, nobody is even close to that. Barring SBI, ICICI, HDFC, nobody is even close to that number. We're even better than, say, Kotak. So Kasa as a blended is doing well. In particular, savings is doing well. We are, of course, hugely helped by a remarkable non-resident franchise, as you know. Our share of remittances is now close to 19% of India's remittances. And the only reason, if you see a reduced deposit growth, we have shed a lot of CDs. When we are actually getting a good momentum on savings, we didn't believe we need to do more on the CD. So it's actually helped our cost of funds too. And our LCR is 240%. And credit growth tends to be a little more soft. So really no point carrying that kind of deposits, which are high cost, which we give up on CD. So blended, Kasa doing well. Our strength on that space hopefully will continue.
Shyam, Federal Bank has gone through this cycle, and that cycle in a sense was a painful cycle for most of the banks a couple of years ago. But last 2-3 quarters, things are looking up. You managed the pandemic very well, moratorium in a sense, numbers were not scary. But yet markets are still not excited about revisiting the stock. And I'm asking this in all sincerity. I hope you where the question is coming from. Markets at an all-time high, markets are giving Federal Bank stock if stepmotherly treatment. Why is that markets right now are not able to understand that there is a genuine turnaround which has happened? What do you think they're waiting for?
Nikunj, this is a question I also ask. I don't have an answer. We can only put the ingredients in place, and which I think the bank has done commendably well. I often heard there was a line around last 2 years as I had got only 1 year renewals. There was this concern whether there is continuity of leadership, or even more importantly, whether there were unaddressed issues. I'm glad that the regulators have given us that comfort that the bank has got a sort of continuity of leadership for 3 years. So with a good portfolio, good team, with hopefully certainty in leadership, maybe those questions will get addressed, and maybe the inflection point is now. But beyond that, I can't quite comment. I can only confirm that performance and quality continues to be strong and will continue to be even stronger. I think the investor, like an IFC coming in, is a very big signal, right? They spend a lot of time reviewing, filtering, and picking their investee company. So I'm guessing they found very strong value in picking us and being the first, whom they're probably doing the first ever green equity. They've come in, they're fully invested, they're 4.99% of Federal now. So we're quite hopeful that all this, capital adequacy improvement, high quality investor, good portfolio, strong team, all of that should help in sort of getting that one overhang you mentioned lifted.
How will you ensure that in this credit cycle, your loan book becomes bulletproof? When I say bulletproof, last time all corporate banks, I'm not pointing out to Federal Bank here, all corporate banks, they suffered because of the economy, whether it was the exposure to steel, power, a lot of other sectors which in a sense had gone through a gut-wrenching fall last couple of years ago. Now that the corporate cycle is picking up, how will you ensure that the same mistakes of the cycle are not repeated again?
I think I'd ask you to go back, say, 5 years and look at the slippages in corporate, look at the rate of growth of corporate and where we have grown. And these are, we're probably one of the more transparent banks that shares all our data. Our book has been all in the right credit grades and has not shown even, thankfully, even requirement of restructuring a moratorium through the last, say, 2 cycles. So it's withstanding quite well. And we are not in any hurry to do very long tenor projects or do projects that have sort of heavy volatility attached to it. So the quality of underwriting, the origination capability and the quality of underwriting continues to be very strong. A governance mechanism around it is, I would say, to use your word, bulletproof. So barring some catastrophe or something that's beyond any of our capabilities, it should continue to hold well. Nikunjan, it's hold, and all signs are it is. The best measure is forward-looking metrics around how the slippages are, how the restructuring demand is, which segment it is in, what tenor it is in, how is the industry category that is there, what are their external ratings. All of that is ticking the right boxes. So I believe that it will hold quite well. And the team has been stable. That's built it for quite some time.
Just to understand this big divergence which some of the banks have reported, and you alluded to that in your initial remarks. I'm just trying to understand that while all the major banks, HDFC Bank, ICICI Bank, even an NBFC like Bajaj Finance has felt the heat of retail NPAs. Similarly, all the lenders have also said that things are normalizing. What is your experience telling you? I mean, is there a problem with the retail book? Should we be worried if there is a third wave? Should we get careful about what is happening on that front?
I'd break that into two. The retail secured needs some relief. The retail unsecured has a very different kind of behavior. A retail secured, and as I secured, is largely around home loans, loan against property. And say if you add gold, that too would be under the retail secured. There, the requirement, hopefully, and at least banks like us, a large part of it is salaried. Now, the salaried have not seen significant job losses. Job creation has been lower, but haven't seen significant job losses. They may have seen either cuts or some kind of temporary bonuses not come in, whatever. To that extent, their cash flows may have been impaired. So I'm hoping that if things catch up, which it looks like it will start getting better in the quarters ahead, should look reasonably okay. The retail unsecured, I think, will have a different kind of behavior pattern. Thankfully, a bank like us, we don't have actually, marginal, may not have much of a problem. I think retail unsecured, because there's nothing to really catch on to, the only comfort is the bureau record. So those who are very determined to keep good bureau records will go all out and make sure that they can pay and use the restructuring that is there. There may be an element of higher slippage in that, is my sense. So if the wave 3 is not as vicious as one hopes it is, not going to be, then I do believe the credit quality of retail books will hold well. Where we must be a little more watchful is the small businesses that are in pockets struggling to come through. And that's where the maximum support has to be. So programs like the GECL program and efforts to give them more relief is probably the more important one.
Absolutely, certainly something to watch out for. Mr. Srinivasan, thank you so much for taking the time for speaking to us, and look forward to speaking to you many more times over the course of the next 3 years. It's been a pleasure as always. Let's slip into a short break, more on the other side, so do stay tuned.